Hi, welcome to this new video. Follow the SPY. No, I'm not speaking about the spies of Mission Impossible or 007. The SPY here is the ETF tracking the S&P 500 index. That, as you probably know, is the index representing the US market. Why am I speaking about following the SPY? It's a good idea to have a look at the S&P 500 to get a sense of the bullishness or bearishness of the market. In other words, when I'm trading, I will not take long position if it's clear that the market is in a downtrend. At the same time, I will not take short position if the market is clearly on an uptrend. Now, the thing is that it really depends on the strategy that you are using. Because some strategies you may be interested just in the short-term trend of the market. Other strategies you may also be interested in a longer-term trend of the market. So with this video, I want to give you the tools to know every day when you look at the market, according to the strategy you have, if you should look for long positions, short positions, or if it's better to stay out. Of course, I'm just speaking about stocks and ETF here, because, for example, if you are into options, there are strategies that can give you money even when the market is going sideways. But that's not the case here. So as you can see, I'm showing the S&P, the ETF, SPY, on the Thinkorswim platform, and these lines are the moving averages. And I'm explaining this in a while, but the thing is that if you don't remember, please have a look at my video on moving averages. The thing is that moving averages are a very powerful tool to identify trends. So here, as you can see, we have 6 of them. So this one, the red dashed line, is the 20 exponential moving average. And this one, the blue dashed line, is a 40 exponential moving average. Then we have this blue line, that is the 50 simple moving average. And then we have the 100 simple moving average in yellow, the 150 simple moving average in green, and finally the 200 simple moving average in red. Okay? So these are the 6 moving averages that we are going to use. Now, in this video, I want to speak about 3 strategies. Okay? So, let's say you have a swing trade strategy, trend following. You are following the main trend and you are in and out in days, maximum week. So it's a very short-term trend following strategy. Then we consider a second one that is again a trend following strategy, but is longer term. Okay? Maybe it's a strategy where you can hold for weeks to months. And then we can also consider a mean reversion strategy, okay, or also called counter trend, where maybe your stock has, for example, a big drop, and you are buying with the expectation of the price to go back to revert to the mean. I consider these 3 because other strategies, for example, let's say scalping, that are very fast, or very long-term strategies where you hold for years, I think they are less affected by the overall trend. So we can just keep in mind these 3. Now, how can we use moving averages in these 3 cases? Well, let's see this now. Okay. So we have to consider, as we said, one strategy that is a swing trade, okay? And as I said here, we hold for days, 2 weeks. And this strategy, we can go long or we can go short. So this is the first one. The second one we consider is, let's call it a trend following strategy that is similar to the swing trade, but we hold for longer term. So weeks to months. Okay, so this is number one, number two, and number three is the mean reversion. And this one usually is also fast. I would say days to weeks. Because usually with mean reversion, you know, when the price is going back to the mean, many times you take profit. So, you know, even this one, number one and number three, often you have a take profit. But for this one, sometimes you just follow the trend and you keep trailing your stop. If you don't know what this means, you can have a look at my previous video where I explained the type of orders, so the take profit and stop and trailing stop. Now, what should we look for when we are doing a swing trade? So that's what I consider. I consider three things for the long. I check if the price is above the 20 exponential moving average. Then I check if the 20 exponential moving average is above the 40 exponential moving average. And I also check if there is a bounce on support. I will explain you later with the chart the meaning of this. And finally, I also check if the price is above the 50 moving average. And out of these three conditions, I want at least 2 out of 3 to be true. But this one must be true. Okay? So I want 2 out of these 3 to be true, and this one. For short, is the opposite. So here we have price less than the 20 EMA, and then we want the 20 EMA below the 40, and we also want to check if there is a bounce on resistance and price below the 50 moving average. Again, 2 out of 3 of those are enough. Let me show you with the chart what this means. Okay. As you remember, we are looking now at the 20 exponential moving average, the 40 exponential moving average, and the 50 moving average. So for example, look here. Here we have the 20 above the 40, so that is correct, it's true. We have the price above the 20, second condition. And also we have the price above the 50, right? Here, for example, let's see. See here. Here we have the 20 above the 40. The price is below the 50 actually, because remember the red candle, the bearish candle, this is the open and the close, so the close is below. and also is below the 20. So this is how we check the conditions, right? We check 20, 40 EMA and then 50 moving average, and then we check the price with respect to this 20 exponential moving average and 50 moving average. And I also say something about the bounce. What do I mean? Sometimes there are very strong level of support, okay, or resistance. And in this case, you can see that the 200 moving average is a strong support, because you see when the price is going here, hitting, bouncing, bouncing again here, and bouncing again here. So this is another condition. When I see the price bouncing, especially with some candlestick pattern, like here we have this bullish pin bar, that is a candle with a very long tail, and usually is a strong bullish signal. Or here you see again and again. When I see that the price is bouncing on a strong support, this to me is an indication of a possible impulse for the price to go up. So if we go here, we see again that we need to have the price above the 50. This is a must, it's not optional. And then we have these three conditions, and we want 2 out of 3. So in a way, these three are indicating the short-term momentum, and this one is more of longer term, medium term actually. So that's how we check. And what happens if you are doing swing trade and then this condition is true, so price above 50 is true, and at least 2 of these 3 conditions are true, then you can look for long trades. On the other hand, if you have the price below 50 and 2 out of 3 of those conditions are true, then you can look for short. In all the other cases, I will not take any position, because it means that the market direction is not clear. And we can see it, for example, now. You see recently what happened, the market is in a kind of consolidation. So let's check what happened here. So the 20 is above the 40, okay, but the price is below the 20 exponential moving average, and the price is also below the 50 moving average. In addition, there is no strong bounce on some support. So if you look here, it means that this condition, price above the 20, is not true. This is the only true condition, okay, this one. And this is not true. And this is also not true. So can you go for long? No. What about short? Well, if you look at short, we have no bounce on resistance. There is no resistance here. And then the other condition on the moving averages are the same, right? So the price is below, true, below 20. And the price is below the 50. So this is correct, fine. But here we have only 1 out of 3. So can we go short? No. It means that if you look at the market today and you are using this swing trade strategy, at least for me, I would not go long, I would not go short. I would just wait for the market to come out with a clear direction. Okay? Let's check now the trend following strategy. Well, for the trend following, I will do something similar. The only difference is that now I will replace this condition, so how I check the medium term, with something that is more, I would say, longer term, kind of, okay? So again, we have to do the same things here. We have to consider, let me just divide this like that. Okay. Trend following. So for trend following, what do? Again, we check this price above the 20 EMA. Okay. Then we check 20 EMA above the 40 and the bounce on support. What we replace is the fourth condition. So the fourth condition, that is the medium-term trend, we do this. We check if the 50 MA is above the 150 MA, and they must be flat or sloping up, or the price must be above the 200 MA, and this one should be also flat or sloping up. So now what I do, I check these four conditions, and I want 3 out of 4 true. Okay? So look at the difference. Here we need to have the price above the 50 and 2 out of 3 true. Here we replace this condition with this one, and we want 3 out of 4. Okay? I think I should have used more space. Anyway, for the short, trend following is similar. So we want price below the 20, 20 below 40, bounce on resistance, and also 50 below the 150, and both flat or sloping, down, or the price below the 200 and the 200 flat or sloping down. And again, we want 3 out of 4 true. So let's check again with the chart if we can take some of this trend following position. So let's look here. 20 is above 40 EMA. Okay. Price is below the 50. Price is below the 20. And what about the short term? Well, we have the price above the 200 sloping up, and also the 50 above 150 sloping up. So if we check our conditions, it means that this one is true and this one is true, and here this one is true, and I think that's all. So can we go long? No, because we have 3 out of 4. And can we go short? No, because we have 1 out of 4. So even for this strategy, as of today, we could not take any position, either long or short. What about mean reversion? So for mean reversion, I'm not really concerned about the medium-term trend. If you see here for the medium-term trend, I take a condition that is more relaxed in a way. I just want the price to be above the 50. Here, since my holding period is longer, I want something stronger. For mean reversion, I don't care. So what I will do for mean reversion, I will just check these 3 conditions and see if 2 out of 3 are correct. So I will basically do the same as swing trade without this price over the 50. So let's write it again. Price above 20 EMA, 20 and bounce on support, and again we want 2 out of 3, and here price below 20 or 20 below 40 and bounce on resistance, 2 out of 3. Okay? And since we have already done this, here the only condition true is this, and here the condition true is this. So we have 1 out of 3, 1 out of 3. What does it mean? That today I will not take any position at all. No short, no long. Of course, I'm speaking about trading methodology where you are just following the trend. Of course, if you are managing a portfolio, doing hedging where you have a lot of long position and you want to hedge, these may not apply. But this is just to give you an idea, because many times when you look at the market, you don't know. You have many strategies maybe, and then you are wondering, should I look for long position? Should I look for short position? What should I do? And in a way it's good, because if you see recently the market has been quite uncertain, so it makes sense to stay out now. When you were here, for example, it was very clear uptrend. So here you would have taken just long positions, right? What about, let's see this one, for example. This may be interesting to check. What would you have done here? Let me take this here. This day. So let's check. Let's go here again and let's see what are the conditions that are true or false, so we can see which strategy we should have taken. Okay. First thing, let's look at the exponential moving average. Here we have the 20 below the 40, okay, and also the price is below the 20. So the 20 is below the 40, 20 below 40, 20 below 40, and the price is below the 20. Okay, so it's quite bearish sign. True. But this candle is also okay. We are also below the 50 and we are bouncing on the 200. Okay, so we are below the 50, so this is true, and we are bouncing on the 200. So below 50, and then we have bounce on support, and bounce on support. Okay, and what about the medium? Okay, 50 is above the 50, flat or sloping up, no, but the price is above the 200, sloping up, so this also is true, right? Okay, so what could we do technically? It was not good for a long term. Why? because we don't have 2 out of 3, and this is not true. This is also not good. The only one that I can see, actually there are 2, is this one, a short mean reversion or a short swing trade. But what happened the day after? Well, the day after, actually the price bounces up. So probably if you enter a short position, it will not have been triggered because there was a very strong impulse. But let's see what would have happened if we look at the market the day after, right? So what is the difference now is that the price is closing above the 20 EMA, right? So now, if we look at this situation, the price is actually above the 20 exponential moving average, right? Is not yet above the 50, and the 20 is still below the 40. So what happens is that now you see that the swing trade short and the mean reversion short would have been invalid. You would not have looked for other strategies from the, you would not have used these 2 strategies anymore. But you could have started to use what? To use these 2, right? Because now we have 3 out of 4 and 2 out of 3. Right, because still we have this situation of a bounce on a support and then it's bouncing up. So when it's bouncing up, you can consider also the second candle, right? If there is a kind of confirmation candle that the bounce was a real bounce. So now you are more confident, and then you can take long position. Okay, so this is basically how it works. You can have a look, you can write down these conditions. That's not for sure the only way to do that, but it's just to give you at least a set of rules that will clearly tell you, okay, I can go and check for long or check for short or nothing. Of course, it's not perfect. I wanted to show you this example where there was the bounce and then the price went up, right? So here you still don't look for any long position, but the day after, yes, you start. And sometimes when you have the bounce, but still the other moving averages are telling you that there is a downtrend, you may have situation like here. You see the bounce. Here there was a bounce, but then the price went down again. Yeah, so my suggestion is you can use this condition. You can, if you have a trading journal that I really suggest you to have, you can go back and check if applying these rules you would have avoided to take trades that eventually became losing trades. And you can also adjust these settings to suit them to your strategy. So that's all for today. Thank you for watching. If you like this video, put a like, subscribe to the channel, and if you have questions, you can write a comment. And see you next time.